Don't give up, you know it's true. You gotta do what you wanna do.
Hello, welcome to UPSC Gangsters. This is Arjun Aryan. I'll be taking you through the business news and economics related news of the Hindu newspaper. And this is for the date 25th September 2017. This is kind of huge. It's a long piece here because we have a lot of important things that happened for this date. So let's get started. The first heading says, saying Tata to a public model, in a private limited meeting, it will be difficult for investors to sell their stake to rivals. Alright, so this is about Tata changing themselves from a public limited to a private limited company. Alright, this is a news piece. I'll straight away take you to the first point. A private structure is a sure shot route to secure the organization from the ill-directed adventures of its members. A private structure puts restrictions on share transfers and sale. In a public company, for instance, a shareholder can sell his or her stake to anyone, including its rivals. In other words, to people whom the current promoters might not be comfortable with. Alright, this is a major issue with the private limited, where the ones who are holding their shares, alright, can sell it to anybody they want. Alright, so there's no need for them to get permission from the board of directors and all that. Alright, so this is one important point. They can sell their shares to anyone under a public limited company, if it's a public limited company. So you know that it's going to be the opposite for the private limited company. Alright, so next point. In the demat era, it has become even more easier to palm off one's shares. However, this is not possible in a private limited company. This may yet prove a push factor for many companies to contemplate conversion into private entities. Alright, so demat era means the demat account era. The era where it has been easier for someone to transfer their shares just with their demat account, alright, using their demat number. So tracing the one who has actually made the share. So these factors are going to encourage a lot of businesses and companies to switch over from public limited to private limited. Alright, so basically you get a lot of privileges when you shift yourselves from public limited to private limited, which is what Tata is doing. So the highlighted features, the highlighted advantages, that comes in the next point. So I will go to the next point. I will tell you the next point. It will also give more control in the hands of promoters, as Tata Sons will also not need shareholders' approval for selling any of its undertakings, borrowing money to invest in trust securities, and appointing people to key positions. Alright, so these are the advantages Tata is going to get when they're going to transfer themselves from a public limited to a private limited company. First thing, no need for approvals, alright, from shareholders. So second one, borrowing money, and again, no need to go through their approvals and all for borrowing money to invest in a trust. Thirdly, finally, alright, appointing people to key positions. So no need to get the approval or the go ahead from the shareholders to appoint people to key positions. Alright, so that sums up the majority of the benefits while you're turning your public limited company to a private limited company. Next point, a private structure is a sure shot route to secure the organization from the ill-directed adventures of its members. A private structure puts restrictions on share transfers and sale. Alright, so when the company is kind of public, under public limited, this is another point you should note. When the company is public limited, you can sell your share to anybody you want, right? But here, that is not the case. In private limited, you cannot sell the shares to whom you like. all right, the shareholders. So that is a major thing. So you actually kind of control the share sale, all right. So a control in the share sale is what Tata is majorly looking forward to, all right. So next point, the same line, all right, including a shareholder can sell his or her stake to anyone, including its rivals, or in other words, to people whom the current promoters might not be comfortable with. This is what happens. This is something that happens in a public company, all right. In the demat era, it has become this is the same point that is being repeated, all right. So I'll go to the next one. Earlier you had the option of being a public company, deemed public company, or a private limited company, all right. Earlier there were options, like 3 kind of options, all right. Public company, deemed public company, or a private limited company. So these are the 3 types of company that was there. Now under the Companies Act of 2013, alright, now under the Companies Act of 2013, you can only be a private limited company or a public company. So note this down. Right now only 2 kinds of company are left, alright, under the Companies Act of 2013. So either you are a public limited company or a private limited company, that's it. Same point. They have chosen the route of being a private company, he said. There is absolutely nothing amiss in the move, according to him. The law is not moving in sync with the ease of doing business. It has made doing business more complex, hence going through the private company route makes sense. So do you understand this line, right? So ease of doing business is how businesses are comfortable with a particular nation, all right? How the businesses are able to flourish, or how easy it is for a business to flourish in a particular country. So the ratings for that is known as the ease of doing business ratings, all right. So when the rating is high, it means that the business can flourish comfortably in that particular nation, all right. When the ease of doing business is kind of low, it seems that the new business that is entering the country will not be able to comfortably flourish, all right. That is what ease of doing business means. So next one, the most important point under this is the current laws are not okay or not in sync with ease of doing business, all right. So the laws right now are making the businesses kind of so the problems that were between them, Tata wanted that to go away permanently, alright. He did not want another mystery episode to happen, so therefore the move of going into converting the company into a private limited company. So Tata conglomerate, totally it is like worth nearly $100 billion and all that, alright. So it is a huge company. So when something like this is happening to that company, people are gonna the other businesses, I mean those people who are owning other businesses will think about changing themselves to private limited companies from public limited companies, all right. So this might happen very soon with the other companies too, because of the example and the misadventure that has taken place with the Tata Sons, all right. So let's go to the next point. A report by a standing committee on finance, Ministry of Corporate Affairs, tabled in the Lok Sabha last year, also seems to acknowledge the new trend in corporate India. The committee observed that more and more private limited and limited liability partnerships (LLPs) are being registered as compared to public limited companies. Alright. So this is a report under the Ministry of Corporate Affairs. Alright, Finance Ministry, and under that Corporate Affairs Ministry. Alright. So they have said that they have seen a lot of registrations under the private limited companies and limited liability partnership companies. Alright, so private limited and LLP has seen a lot of registrations compared to public limited companies. Alright, so that is an important point you have to note here. So next, they're giving the details. As many as 52,144 LLPs were registered as on December 31, 2015, of which only 51,315 LLPs were active. It, however, noted that such a trend was not very healthy for the growth of the corporate sector. He's saying, I mean, there is a difference between 52,000 LLPs that were registered and the things that were active right now. Alright, nearly 1,000 odd companies are not active. Alright, and they are saying that this is not a healthy approach. You know, a lot of companies that are trying to register themselves as private firms, alright, private limited and limited liability firms, alright. So that is not an encouraging trend. The government also feels, obviously, alright. So at the end of the day, it's about the ease of doing business, right? Just like how it was said previously, alright. It is about the ease of doing business that would that would actually persuade a person to register the company under a private limited or a public limited company. Next point, pointing out that the trend could be due to the detailed and cumbersome procedures and rules under the Companies Act 2013. This is what it was previously said. It urged the ministry to examine the issue with a view to simplifying and rationalizing the related rules and procedures under the Act. So, when these procedures and rules under the Act are kind of eased, alright, and kind of rolled back, and it is going to be easier for them to comply, and then a lot of companies might register themselves under the public limited wing, alright. So in this alright, till here you should definitely know what a private limited company is and public limited company. We just saw the overview kind of thing of it, alright. So how the private limited company is different from public limited company and the kind of advantages that are there, alright. So there might be questions from this in prelims for sure, since this has been a big issue and has been going on for months and weeks right now, alright. So what we are kind of, since the questions might be asked from this, we have to know the overview of the differences between the private limited companies and the public limited companies, because certain features might be asked, certain features that can be asked, like how or whether this comes under the ambit of public limited company, or does it come under the ambit of the private limited company, and all that, alright. So the basic differences I'm going to give you. A company, take it, I'm also putting the typed version of it, so just listen to it. So the private limited company, when all its shares are in private hands, so it will be known as a private limited company when all of its shares are in private hands. And private limited company is owned by a group of promoters, alright. So group of promoters own a private limited company. On the other hand, the shares in a public limited company are open to everyone, alright. Anybody, the public, normal public. So anybody who has registered himself with the demat account, they can come and buy it, alright. So it's not like kind of only certain people can own the shares, and it's not like selected few are only invited and all that. Everybody can come and anybody can own the shares of it, alright. That is some a feature under the public limited company, the literal meaning of a public limited, alright. So the public limited company will not be in the hands of a few promoters, alright. So here the public actually owns it, alright. So public owns the company. That is why they have to get the approval of each and every shareholder there. So there is also a difference in the number of shareholders in the two types of companies, alright. In private companies, the shareholders should be 2 and the maximum 250, at least 250, alright, in private limited. Then in public limited it is 7, and maximum it goes to to infinity, alright. Many can own shares. It's like there is no fixed limit to the number of people that can own a share in the public limited company, alright. So it is limitless. So when talking of shares, the shares can be freely transferred in public limited company. Just now we saw that was supposed to be the problem that the Tata Sons are facing with mystery. Alright, so no need to get the approval of the board of directors and all that. So under a private limited company, it's not possible. So if our shares of a private limited company have to be transferred, the consent of the shareholders must be sought. Alright, so private limited company cannot make a public offer of its shares. They cannot do that. So when they have to do something like this, they need the consent of their shareholders, like the major shareholders we are talking about. Alright, not the public shareholders. So on the contrary, limited companies can make a public offer through advertisements. So limited companies, when they say just limited is coming, if limited alone comes, it means private limited companies. That also you should note. Alright, so when they say only limited, it is public limited. So when they say only limited, it is actually public limited companies, not private limited. When they say private limited, it will be written private limited company completely. So if there is a company that its name ends by just limited, it means that it is a public limited company. Alright, the next would be these are the basic differences between public limited companies and private limited companies. Alright, so let's go to the next point. The shares of a limited company are listed in the stock exchange, whereas it is not in the case of private limited company. This means that trading happens with a limited company in the stock exchange, and nothing of that sort happens with a private limited company. Huge difference here. Alright, so a private limited company will never come inside a stock exchange display. Alright, so it will never be displayed in the stock exchange. But the private limited companies, the public limited companies will be displayed in the stock exchange. They can take part in the market. So private limited companies cannot come in the stock exchange ambit. Alright, so that is a very important point. So whatever companies that are listed on the stock exchange, they are supposed to be public limited companies. Alright, so private limited company, next one. A private limited company is a partnership firm, whereas a public limited company is a full-fledged corporate body. So another point to note, the private limited company is a partnership firm. So have it in mind, private limited company is equal to partnership. Alright, between two, the said stipulation. Alright, two people or more. So public limited company, on the other hand, is a full-fledged corporate entity. Alright, so please have that in mind. Next point, the public limited companies come with stringent rules and requirements, which we know. Alright, on the other hand, no such stringent rules or requirements are applicable for a private limited company. So it is difficult for the company at the end of the day to comply to the standards of a public limited company than complying to standards that come under the private limited company norms. Alright, so this is the news piece. I'm ending the first news piece. I know it is pretty long, but there are a lot of things you have to know about the private limited and public limited company. So please expect a question from this in prelims and be prepared for it. Alright, it's not something that is tough. It's pretty easy, which I have I've kind of filtered it down for you, so you'll be having an idea of what a public and private limited company are right now. Alright, so let's go to the next news piece, which is another very important news piece. Alright, so the heading says, who's lending to Indian businesses? Subheading says, banks share in new credit fell in financial year 2017 as corporate bond issuance rose by 56% and NBFCs lent more. Alright, this is the subheading. So you get the idea of it, that banks lending loans for businesses have reduced, and those non-banking financial institutions and other methods have contributed greatly to investing or raising loans for businesses. Alright, so let's get with the first point. With the banks busy chipping away at the mountain of bad loans and operating on precarious levels of capital, who will fund the credit needs of Indian businesses? Alright, we have a problem with the non-performing assets and all that, right? I told you about this previously. So the non-performing assets from the corporate side is actually having a lot of effect on the banking system. I mean, the non-performing assets of normal citizens and consumers, no, not that. The non-performing assets of the corporate sector. Something that is similar to what happened with Vijay Mallya and Kingfisher, right? There are a lot of incidents like that that have contributed to the non-performing assets of the banking system. So, when all this is happening and the banks do not have enough credit to their account, so people obviously turn to other means to raise loans. Alright, so let's get to the point. Reserve Bank of India's recently released annual report of 2016-2017 shows that many new sources of finance are springing up. Domestic businesses are increasingly turning to bond markets, non-banking finance companies that are known as NBFCs, and foreign direct investors to meet their funding needs. So please note this one down. As per the RBI report, alright, recent RBI report, 3 sources that the businesses use regularly for raising capital. Alright, the first one is bond markets, the second one is NBFCs, alright, third one is foreign direct investment, that is investments from the foreign countries. Alright, so next point, RBI's compilation on the flow of financial resources to the commercial sector shows that financial year 2017 marked a watershed year for Indian banks' share in the commercial credit. So RBI's report, obviously it shows that credit has been raised from other 3 sources which we just discussed. It means that the banks, alright, the bank's credit ratio, in the sense the bank's dominance over lending loans to businesses have really reduced right now. Alright, next point, in the 4 years ended financial year 2017, domestic businesses soaked up between rupees 12.8 lakh crore to 15.18 lakh crore per year in credit funding. So there has been a rise from 12.8 lakh crore to 15.1 lakh crore, alright, in the financial year 2017 compared to what was happening 4 years earlier. So there has been some 3 lakh crore increase, alright. So until financial year 2016, the banking system met 50% or more of this requirement. So remember this will come in handy for your mains answer. Till financial year 2016, alright, till financial year 2016, 50% of the credit requirement was met. 15% of the credit requirement for businesses was met by the banking institutions. Alright, so keep that in mind, which is not the scenario anymore. Alright, so these were met by the by the banking institutions. So now they have been met by the 3 sources which was discussed earlier. Next point, but in financial year 2017, banks' share in new credit slumped to 35%. So have that in mind too. So now it is just around 35%. Alright, so now it is 35%. It has reduced from 50% to 35%. While non-bank sources met 65% of financial requirement. So remaining 65% has been met by non-banking sources. So those structures and institutions that are away from commercial and regular banks, they have funded the businesses. Non-bank sources lent as much as rupees 9.25 lakh crore to businesses, dwarfing bank credit flow of rupees 5.02 lakh crore. So who are these non-bank lenders to enterprises and how are they funding themselves? Alright, so you see as much as 9.25 lakh crore has been spent on businesses from non-banking sources. So who are these? What are these types of non-banking sources? Who are these non-banking sources, and where do they get these huge sums of money? Alright, that is something we'll be seeing in the next point. This number has almost doubled from rupees 1.65 lakh crore in financial year 2014. This data only includes the bonds directly floated by commercial enterprises and not the money raised by finance companies for on-lending. Alright, so according to the financial year 2014 report, alright, the non-banking financial institutions credit has doubled, alright, and these actually, the data actually points towards only the bonds that are being floated by the commercial enterprises, alright, those NBFCs. They're not even talking about the kind of money that has been credited, or the kind of money that has been used for crediting the businesses through on lending. Alright, so what is on lending? On lending is when an organization, alright, or when an institution actually lends the money that they have borrowed from another organization. Alright, so one particular institution is there. Imagine that they are getting their loan from HDFC. Alright, the HDFC loan, what they are getting, alright, that loan again is dispersed to other people. Alright, the money that has been got as the money that has been taken from HDFC as a loan, alright, that loan money is used by this company to float as loans to other entities. Alright, that is only known as on lending. So please note that this term, this might also come in your prelims. Alright, next point, what has prompted this sudden takeoff? On the borrowing side, look at this next point, alright. On the borrowing side, firms have taken to bond issues to source more of their requirements because bond markets have transmitted the recent fall in interest rates much more quickly than effectively than banks. In the last couple of years, it has been much cheaper for high quality corporate borrowers to tap bond markets. So, using bonds, alright, the majority of the credit of the companies has been met by issuing bonds to the public, by issuing bonds to those preferred people and all that. So bonds, basically a company will issue, and the one who's buying will buy the bond, and whatever interest that is stipulated in that bond, that will be returned, alright, that will be credited to the one who's buying the bond as per the contract, either monthly or biennial basis and all that. Alright, so that is where the majority of the industry is getting their credit from. Alright, so this is actually kind of a good news, because we felt that the market side, alright, the capital market of India was not developed, alright, which is the other way around if you consider matured economies like US. Alright, in US, bond markets and the share markets and the entire capital market is more prevalent, more powerful than the banking system there when it comes to raising credits. Alright, and that is the indicator that the economy is actually maturing. Alright, so an indicator whether the economy or the industry is maturing or not, that indicator will actually depend on the capital market. Alright, so capital market of an economy is equal to the maturity, alright, of the industry that is there. Alright, so this is something that is happening here, which is good. Alright, that is why even in USA people will invest on stocks, capital markets, rather than depositing the money in savings account. Alright, here you have the the savings account interest somewhere ranging from 6% to as high as 8%, and some banks, local banks, which will give you around 10%. In USA, it is just around 1%. Alright, that is the amount you will get if you invest in the savings bank account of the banks. Alright, because the industries are well developed there. Alright, and people find it more profitable to actually invest in companies rather than banks. Alright, so slowly this is happening here. Alright, and this is how the companies are actually raising credit for themselves. Alright, So that is happening here, and this is about not people investing in the banks, but the industries or the companies getting loans, all right, from these sources instead of the banks. All right, so from the banking point of view, it is kind of not going good, all right, because there has to be balance, which is seemingly not there right now. Next point, on the lending side, retail savings flooding into mutual funds, insurance firms and pension funds have helped stoke the domestic institutional investors' demand for bonds. Alright, so mutual funds, insurance firms and pension funds, alright, so they have helped for in getting credit for the institutional investors. Alright, so that's what is said in this point. Insurance firms and pension funds have helped stoke the domestic institutional investors' demand for bonds. So finally, the mutual funds and all that have been successful in gaining people's attention. Alright, so through this also the credit has been flowing to the industries. Next point, these trends taken with active efforts from RBI suggest that bond markets may continue to remain a leading source of credit to businesses. And the previous point, another thing that I forgot to mention is RBI's steps. Alright, whatever RBI's policies are, the repo rate and the bank rate and all that, whatever policy that has been taken by RBI, it has reflected sooner, alright, it has reflected faster in the capital market than in the banking sector. Alright, so the monetary policy is not something which the country's central bank introduces and overnight it actually filters down and changes the economy. Alright, it is not like that. It takes some weeks and sometimes months actually to see the actual result in the economy. Alright, but here when you take countries like USA, of course it is more prominent. When the monetary policy is being rolled out, it will be reflecting in a week, alright, in a matter of days. Not so in India. But here what has happened in our country, alright, the reflection was more prominent in the capital market, more faster in the capital market than compared to the banking sector. Alright, that is one of the reasons why the capital market has gained momentum in providing credit to the industries. So coming back to the point, these trends taken with active efforts from RBI suggest that bond markets may continue to remain a leading source of credit to businesses, offering stiff competition to banks, a self-explanatory point. Alright, next line, the only caveat, only clarity is that the bond market route is more accessible to large enterprises with good credit ratings than small and medium enterprises or borrowers with low ratings. So this is a kind of problem for these small industries, small and medium industries, because the bond market and the share market is accessible only to the large companies, alright, so the large industries. So those people that actually own small businesses, for them it is actually not accessible. Alright, so the bond market is not accessible, meaning these people cannot raise credit from such capital market sources. Alright, and these people are left out. Alright, and you have to remember that these people form the majority of the industries in India, from the medium and small enterprises. Alright, so when these people are left out, it is not actually a good news. Alright, so let's go on to the next point. The subheading says NBFC scale up. Alright, under that, the first point, non-banking finance companies have emerged as key financiers to businesses, especially MSMEs, which is the medium, small, micro enterprises. RBI data shows that in financial year 2017, NBFCs and housing finance companies extended rupees 2.59 lakh crores in credit to commercial enterprises, meeting 18% of their total credit needs. NBFC lending jumped 28% over financial year 2016. So this you have to remember the kind of jump that the non-banking financial companies have achieved. Alright, from the previous year that was calculated from financial year 2016, they have witnessed a 28% jump. Alright, so non-banking financial institutions are those that are not like the regular commercial banks. Alright, so you have the chit funds and all that, right? So chit funds would be a great example for non-banking financial institutions. Alright, so those kind of people have seen a lot of growth, they are saying. Alright, and they have been the major source of funds for the industries. Alright, and they have been the major source of funds for industries from the MSME also. Alright, like it is said here, the micro, small, medium enterprises, right? So especially micro, small and medium enterprises, they have actually gained a lot of momentum, and they have been gaining a lot of credit from NBFCs as well. Alright, so this is a point which you have to remember. So who is actually kind of replacing the banking system currently in lending credit to industries. Alright, so now moving on to the next point. For long, it was a sore point with entrepreneurs that the large corporate borrowers ended up cornering the lion's share of bank credit, with lending procedures effectively keeping out micro, small and medium enterprises. So, about this point, previously it was these huge industries, alright, that were actually swallowing all the loans from the regular banking institutions. Alright, so when that happened, obviously who is left out? The medium, small enterprises. Alright, medium, small and micro enterprises, they were left out. Alright, so it was thought that it was the huge companies that were getting those credits from the banks. In the last 3 years though, wholesale NBFCs have aggressively stepped into breach, leveraging their deep regional reach, closer relationships with customers, and alternative credit appraisal systems. NBFCs have driven a manifold expansion in loans against property and unsecured business loans to MSMEs. So basically the norms and the compliance rules, all this have been the actual requirements for releasing credit. Alright, so the requirements in releasing credits, so the NBFCs had low requirements. Alright, so since they have low requirements, majority of the credit, they were more flexible. Alright, majority of the credit has been taken from NBFCs. Alright, especially for MSMEs, right? So those places where you needn't give security. Alright, so unsecured business loans have been given from NBFCs, which is not possible in the case of normal commercial banks. Alright, so next subheading says NBFCs gain share. So under the subheading, a CRISIL study in November 2016 noted that NBFCs had gained a 3 percentage point share of overall credit pie from banks in the last 3 years as a result of their mortgage and MSME lending push. Alright, so CRISIL is an agency, and according to their study, NBFC have actually increased, alright, by 3% when it comes to providing credit for the MSME. Alright, this is according to the report of 2016. Reporting year is 2016. Housing finance NBFCs have emerged as a major source of funds for real estate developers too. So housing finance NBFCs, those non-banking financial companies that focus on housing and real estate loans, alright, they have seen a huge increase. Alright, they have been a major source of funds, alright, for real estate developers too, with financial institutions such as LIC, SIDBI, National Housing Bank and NABARD playing a compulsory role in funding other businesses. So LIC, Rural Development Bank, National Housing Bank, they've all come into the picture. So but anyways, it be LIC, NABARD, the Rural Development Banks, alright, so they are all coming under the government anyway, so no huge surprise there or huge negatives in that. They have been taken into account when it comes to lending for small businesses and all. Alright, so a lot of credit has been flowing from these people as well. Alright, so which is actually good news for the government's initiatives that has been taken for years and years. Alright, so they have been also occupying the major credit flowing stream. Next point, Two factors have helped NBFCs expand their lending activities at the cost of banks. Two factors that have helped NBFCs. These two factors you have to note once again. So, two factors that has helped NBFCs. All right. So the factors, their comfortable capital adequacy ratios. In the sense, their compliance norms are easier, right? So the commercial banks might have stringent rules, like you should have so much of crores, so many deposits and all that in the form of security and all. But NBFCs are okay to relax that. All right. So they are comfortable capital adequacy ratios are one of the factors. Next factor is and their ability to borrow at lower costs due to falling interest rates. So the interest rates from the non-banking financial institutions are also low. Alright, so the compliance is also comparatively less. Alright, you needn't sum up a lot of documents, you didn't satisfy so many conditions, you needn't give them so many securities to get the credit, and at the same time the interest rates are also low. So it's obvious that people will actually choose the non-banking financial institutions, right? So these are the two major points which you have to remember why NBFC is actually gaining momentum. Alright, same line, in the next couple of years non-banking financial companies have been even more aggressive than corporates in tapping the bond markets for capital. So more than more than the corporate companies, the non-banking financial institutions, they have tapped into the bond market, which is the capital market. Alright, so compared to corporate companies, these people have concentrated their efforts on tapping into the capital market. Alright, that is also one of the huge reasons why NBFCs are more successful than the banks of late. And they have also augmented their resources by borrowing from banks and institutional investors through securitization deals. Lately, though, there is a worry that the sluggish property market will force NBFCs to tread more cautiously on loans against property. Alright, so they have actually resources. The NBFCs have also got loans from banks and they have redistributed. That's what this point says. So which we saw previously, right? The kind of organization that gets the money from a bank and redistributes it as a credit to other institutions. Alright, that we just saw some moments back what it was called. Alright, but this here, alright, here what we are talking about is not about on lending, alright, which is similar to on lending. Alright, so these people are getting, the NBFCs are getting loans from the banks, alright, the commercial banks, and they are redistributing. So it is a type of on lending. Alright, so this is something NBFCs have capitalized on. Alright, they have redistributed the loans that have been got from the banking institutions. So which is actually on lending. Next point, and one more point, and that is they are actually of late, the NBFCs that are financing the real estate companies, the housing companies, they are actually kind of more cautious because the real estate has been sluggish for some time now. Alright, next point, while domestic non-bank sources such as bond markets and NBFCs have met about 46% of the total credit needs of businesses in financial year 2017, foreign sources have chipped in with about 19%. These are the figures. So figures, you needn't remember the exact number, but at least you should remember the 40s or the 20s or the 10s. Alright, at least under what range they fall under, right? That at least you should remember. So according to this, NBFCs, alright, have met 46%. Alright, have met 46% of the total business needs, credit needs. And FDI has contributed to about 19%. This is obviously a growth. Alright, so rest is from the banking institutions, obviously. Next point. Here the good news is that rather than external commercial borrowings or short-term credit, it is the more durable FDI money that is meeting this need. So, external commercial borrowing is the borrowing that is done by the government to meet certain requirements, right? But right now that is not happening. Alright, the good news is FDI is coming in. FDI in the sense, companies are directly investing in their branches in India. Alright, so when that is happening, it's not like we owe them, as a nation we owe them money. It's not like that. Alright, they are conducting their own business here, and they are providing the services, they're making business here. Alright, and they are profiting from it. Alright, so FDI is kind of different from external commercial borrowing in that sense. Alright, this is actually not loan, it is kind of an investment that is made in the country. Next point. While it's heartening to see these alternative sources filling in for bank credit, it is essentially to recognize that these cannot completely substitute for bank lending. In April-June 2017, for instance, bank credit flow to the commercial sector actually shrank by rupees 1.92 lakh crore. It shrank by rupees 1.92 lakh crore, despite non-bank sources pumping in rupees 1.65 lakh crore. The aggregate flow of finance to business contracted by rupees 27,300 crore. Alright, so this is when it comes to the commercial sector. Alright, so the commercial sector aspect, the banks were able to disperse more compared to NBFCs. Alright, so the small shops and all that, right? In those things, obviously banks were having the bigger say, but that by itself is actually a reduction compared to the previous years, it seems. Alright, so this is the cause of a worry here. Next point, the other useful takeaway from the analysis is that one can no longer assume a one-to-one correlation between bank credit growth and GDP growth numbers. This is very important for you to note. Alright, so bank credit alone, alright, so you have to know that bank credit alone is no longer the indicator of the GDP of a nation, the GDP growth of a nation. Alright, so that alone is not the factor they are saying. You have to consider obviously who this time from now on, the non-banking financial companies too. So same line, to really measure credit expansion in the economy, we need data on both bank and non-banking lending, just like I said. To extend this logic further, if bank credit growth slumps to a 20-year low as it did in March this year, it needn't necessarily spell doom for the economy. So March this year, we have seen a 20-year low of bank credits. Alright, that you should remember. It will be very useful for your main answers. Alright, bank credit has seen a 20-year low in March. Alright, March 2017. So these numbers should not indicate that, oh my god, the economy is in peril, the economy is gonna be doomed. No, because as we saw in this news piece, the non-banking financial companies are actually filling in a great extent. Alright, so therefore we have to consider the other factors too, and not only based on the credit that is going from the banking institutions. You should come to a conclusion that the economy is going well or not. Alright, so this is about it for the second news piece. I know it was kind of long, but it's pretty important from the economics perspective. Alright, let's go to the next one.